Hi everyone. I'm just going to do a quick percentage of completion method for cost accounting purposes for your exam practice for CPA, or if you just want to find out how to do the percentage of completion method for a construction project. This is your method. I'm going to go over the problem. So the problem is pretty simple and typical as it can get. Basically, we have Height Homes Inc. is a home builder company that purchases building sites and builds homes on them for sale. One second, let me see if it's recording properly. And identifies a buyer's specifications. However, Height Homes owns all the properties throughout the construction period, and the buyer of the home does not obtain control of the property until all work is complete. An identified buyer could walk away during the construction period, and Height Homes could sell the homes to someone else. Okay, these are the numbers. Be aware of these. On January 1st, year one, Height Homes begins work on a home for an identified buyer for which um for an home for an identified buyer for which the contract price is 200 grand, 200,000. The company estimates the work will cost 192,000. During year one, the cost incurred is 36,000 is spent on the work, which means it's the cost incurred. And the company's engineers believe that work costing 144 remains to be completed. Okay, 144 remains to be completed out of the 200,000. Okay, let's look at during year two, another 90,000 is spent, but because of problems with the construction, 79,000 of work is now estimated to remain. Okay, so we know that there's a problem in the project. The question is hinting towards something, and we will find out what that is. So, what is the impact on net income to be recognized by Height Homes in year two? And we have remaining work estimated to remain at 79,000. Okay, so just to give you a quick theory on percentage completion method, the key takeaways is that percentage completion is applying the matching principle because it talks about revenues and expenses that are being recognized in the same period in which they're incurred, providing a more accurate reflection of financial performance. This can avoid the large fluctuation in profits that would occur if revenue were recognized only at one project completion, but hence it does it by phase, and breaks it down into timeline and breaks it into phases of construction. Revenue recognition principle is recognized as the work progresses based on the degree of completion. This aligns with the idea that control of work performed and economic benefits are being transferred gradually. That's why the buyer has the right to walk away because he hasn't fully been transferred the liability. So the contract is still kind of open ended, right? So we need to understand that. Cost to cost basis, the most common approach with the percentage of completion method, where the percentage of completion is calculated by comparing costs incurred to date to the total estimated cost. This provides an objective measure because costs are typically well documented. Core formula, we have a few determinants. We have to find the revenue to date, we have to find the gross profit to date, we have to find the current period profit, and we have to find the cost incurred to date. And how we're going to do that, we'll just get right into the numbers. So another way to remember this theory is that long-term contracts such as construction, engineering, shipping, building, or manufacturing plants, when outcomes of the project can be reliably estimated. So like I said, like a house gets broken down into a big project where you hire tradesmen, electricians, plumbers, wood carpenters, wall installation people on different walks of tradesmen, and your projects get slowly built up throughout the phase of maybe like 6 to 8 months. Your house will get built. You have the architect, you have the designer, the engineer, the surveyor, on the concrete team, stuff like that. Advantage of the percentage method, it provides a real-time view, so we know what's happening in the profitability of, because it's providing a real-time view, offers better matching for revenues and expenses. So let's look at what are some of the risk factors. Revenues requires accurate cost estimation. Any errors can distort profit recognition. That's mainly what it is. As a cost accountant, your numbers has to be too precisely accurate enough to measure the profit and loss on an ongoing basis. That's why you get paid to be a cost accountant. Okay, so according to the question, cost incurred in year one was 36,000. In year two was 90,000. The remaining in the year three, end of year two, was 79. So we're gonna add these costs up, and that will give us 205. This is a total estimated cost. Adding the year one, year two, and the remaining at the end of year two, which the question tells you, gives you a total of 205,000. Um, Now we're gonna find out the first percentage completion ratio. Um, so we have the year one cost is at 36,000 plus 90,000 overall over the total cost incurred, which we found out. It's 205, so that will give us a ratio of 61.46%. This fraction is actually representing the end of year two percentage completion of revenues. Okay, so now we can calculate that since we got the fraction. So 61.46 percentage time 200,000, which was the contract price. This was the contract price times the percentage completion ratio, which gives us a result of 122,920 dollars. And year one calculation for comparison: estimated cost to complete year one is 144. Total estimated cost of year one is 36,000 plus 144, which will give you 180 total. So how we get 36,000 is the cost that we get in year one, which the question will tell you. I'll just go over the question again. It'll tell you 36,000 for year one, 36 for year one, costing again year 244, which will give you a total of 180. So that's when we got, and then we're gonna take the whole percentage fraction. So we know how much revenue to recognize. So we're gonna take the first 36 cost over the total 180 cost, over the total overall cost of 180,000. That will give you 20% ratio fraction. So you times that by the contract price again. So times it by the contract price, but the original contract price will be given in the question. Now you have 40,000 to recognize for comparison. So let's do gross profit right away, since we know that in year two the cost was, in year one the cost was 36 and the revenue was 40,000. So gross profit automatically comes up to be 4,000 profit. Determine revenue and gross profit for year two. Same thing applies. You just carry on the values. Revenue recognized cumulatively year end of year two is $122,920. Revenue recognized already in year one, which we calculated from this gross profit of 4,000 is 40,000 in revenue. So you take the remaining to be recognized in the cumulative balance, 122,920 minus 40,000, which already been recognized, gives you 82,920, which will give you revenue in year two total of 82,920. So now gross profit in year two. Gross profit in year two is actually not a gross profit because we have a cost of 90,000 and the revenue left to be applied is only 82,920. So we actually have a net loss, which is 7,080. So that's why I was saying, when the question is going to say hint towards problems with the construction, that could basically apply into a net loss. So in this question, we have a net loss of over a little over $5,000, $7,080. So here we go. That was the question of completion method. I hope you guys got it. If you have any questions, let me know. I'll share this problem in the link. Thank you so much. Have a wonderful day. Bye for now.